Right now, if you treat India like a single listed company, its Nifty total market, that's just 750 stocks that capture 96% of the market's value, that is trading at a price of 36x earning. That's half of profitable companies actually trading above that. At the same time, the so called cheap stocks have almost disappeared. Only 33 of 750 names. That's just 4.4% of the universe and 5.3% of the market cap that trade below the 10x PE levels. Now, even dividend hunters, they don't have it much better. Now, across the market, the median dividend yield is only 0.41%. And even at the 90th percentile, you're still at 1.96%, with only 28 stocks yielding more than 3%. Now, this is a market where cheap and high yield, they're tiny niches. They're not the norm. Now, even if you look at it as one giant portfolio, the picture is staying rich. The Nifty 750 taken together trades at about 25.4x trailing PE and roughly 3.58 PB, and the market cap weighted yield of just 1.08%. The flagship Nifty 50 is a shade lower at 22.3x PE and 3.5x PB and 1.3% yield. So the broader universe is clearly more expensive. But you strip away the index weights and you go stock by stock, the skew is dramatic. The average PE jumps to about 60.4x, but the middle stock, the median, is around 36.3x. And that simply means half the stocks trade below 36x and half above it. At the cheap end, only 10% of the stocks are trading roughly 13.8x PE. And at the expensive end, only 10% of the stocks trade above 86.8x. So, in other words, right, it's a small set of very expensive stocks that's pulling the whole average up. At one end of the market, investors are paying about 90 rupees for every 1 rupee of earnings, and on the other end, they're barely paying 14 rupees. So yeah, on headline numbers, the market looks expensive and very skewed. But a P ratio is only half the story. The other half is what's really happening to the earnings underneath. Welcome to Bottom Line by Groww. In today's episode, we're going to be unpacking the Nifty's total market, its history, the Nifty 750, valuations, dividends, and we'll start busting some of the biggest myths around what's truly cheap or what's really expensive. But before we jump into bubble or this is cheap or that is expensive, we need to see how India Inc. has grown over time and how valuations have moved along with that growth. And over the last 2 decades, India Inc. has gone through 3 very distinctive phases of growth, and we'll talk about all 3 of them. From 2003 to 2008, profits of the Nifty 500, which is a pretty good proxy for today's Nifty 750. Now, this universe grew at around 30% CAGR, while India's GDP grew at roughly around 14.5% CAGR. In that boom, corporate profits, they grew much faster than the economy. So the profit to GDP ratio roughly doubled to 5.2%. Then the second phase, between 2008 and 2020, that picture flipped. GDP doubled, but the listed profits more or less went sideways. And the profit to GDP ratio, that fell from 5.2% to 2.1%. And in other words, what that means is that India's GDP growth does not automatically translate into equity earnings growth. What really drives shareholder returns is the profit to GDP cycle, not GDP in isolation. Now, after COVID, the cycle turned again. Between 2020 and 2024, listed profits in India, they grew at up to 30% year on year in some years, while GDP grew at around 15%, lifting the profit to GDP ratio roughly back to about 4.8%. Now, over the long run, stock returns have followed these profit waves and their share of GDP, while valuations have expanded and contracted around them, rather than moving randomly. You see the same pattern even if you line up the Nifty 500 PE as a proxy against the Nifty 750 against its earnings per share growth. Now, in December 2007, the Nifty 500 traded at about 26.7x earnings against a strong 3-year EPS CAGR of roughly 24.6%. Well, valuations were rich by historical standards, but at least they were being propped up by some, fairly genuinely strong growth. By 2013, the PE had fallen to around 18x, yet the 3-year EPS CAGR was only 5.2%. The index looked cheap on PE, but earnings weren't growing at all. It was the classic cheap because nothing is happening. By 2019, valuation stretched further to 30.8x, while multi-year earnings growth was stuck at 5.1%. So you fast forward to 2021 to 2023, the PE cooled to the 25.6x zone. But this time, the 3-year EPS CAGRs, they jumped to 45%, well, thanks to a lot of the post-COVID profit recovery. The multiple bands looked similar, but growth was completely different. Now you bring this lens to today's Nifty 750. Now the index that's currently trading at 25.4x PE, and that's a clear premium. And this comes after only 11.4% earnings per share CAGR over the last 2 years. It's hardly a blistering earnings boom. On the surface, this growth, it feels rich. So the real question we should be asking is, what exactly are we paying for? And if market PE is high, so everything is expensive? To answer that, we'll slice the Nifty 750 into earnings growth buckets. Now, if you bucket the Nifty 750 by 3-year earnings per share CAGR, you have about 140 companies. This is nearly 19% of the companies. They have actually seen earnings shrink over the last 3 years. But this negative growth group, they still trade at a median PE of roughly 38x and a median PB of about 2.87x. This is a part of the current story where even low or no growth stocks are there commanding high earnings. Now you move it up one step to the 0 to 5% earnings per share CAGR bucket and you'll find 51 companies. This is representing about 5.5% of the market cap. They're trading at a median PE of 31.8x with an ROE of around 14.2%. Next, you move to the companies compounding EPS between 5 to 15% a year. There are about 117 such stocks, roughly 16.4% of all companies. But in terms of size, they are punching above their weight. They make up a chunky 24.5% of the Nifty 750 market cap. So in other words, almost 1/4 of all the money in this market is sitting in businesses that are growing profits by 5 to 15% a year. Now, these stocks trade at a median PE of 35.5x with a median PB of 5.56 and a median ROE of 15.8%. So, investors, they're happily paying around 35x earnings for these moderate growth names, and it's most likely because they see them as strong brands, there's a solid moat, or there's some balance sheet comfort, and they're happily willing to pay up for that perceived stability. Now, you move one step higher to the 15 to 25% EPS CAGR bucket. Here we have 102 companies accounting for roughly 17.8% of the total market cap. Now, this is what most investors would call healthy high growth. But you see their valuations. These valuations are not crazy. Median PE is here around 36.37x, and it's quite similar to the 5 to 15% bucket. For this group, paying low 30s PEs for 15 to 25% earnings growth actually looks reasonable to attractive on a growth adjusted basis. But the real eye-opener is the very high growth bucket. So we have 302 companies. That's a massive 42.4% of all stocks with valid numbers. These 302 companies have delivered more than 25% earnings per share CAGR over the last 3 years. And together, they account for 38.5% of the total Nifty 750 market cap. A big chunk of this post-COVID rebound, its profits bouncing off depressed FY20 levels to normal or above normal earnings in FY22 to 24. So even with that caveat, this growth is real and big. But here's the twist. Despite this greater than 25% EPS growth, the median PE of this high growth group is only about 35.3x, which is actually slightly lower than the overall market median of 36.3x. So on average, you are not paying a huge extra premium for very high growth. If anything, you're paying similar or even slightly lower multiples than you are for many moderate growth or even low growth names. Now, if you put these growth buckets together, the picture is blunt. The 15 to 25% and the greater than 25% earnings per share CAGR groups, and you get about 56% of the total market cap in stocks compounding earnings faster than 15%. At the other end, The flat or negative EPS buckets together add up to only about 17% of the total market cap. So, behind these headlines of an expensive Indian market, what you actually have is a majority of value sitting in businesses that have delivered over 15% growth, typically at PEs in the low to mid 30s, and a smaller but important pocket where profits are flat or falling, yet valuations are in the similar range. That's exactly where the price to growth equation breaks down. In some parts of the Nifty 750, investors are getting very strong earnings, compounding at only average valuations, while in other pockets, they are paying market-like or even higher multiples for little to no growth. And that's exactly why PEG, that's the price relative to earnings growth, PEG. The PEG is a much cleaner lens than PE in isolation. So instead of asking, is 38x PE expensive? You should ask, 38x on what growth? In the Nifty 750, zero growth and 50 to 25% growth buckets both sit at 38x median PE. But the PEG tells you which one you're overpaying for. And it's also what should make you very nervous about the 80x plus PE stocks with single digit growth, where a single wobble can lead to a big derating. So now, how does valuation play out when we start slicing the Nifty 750 universe by a market cap bucket? Let's start with the top 100 large caps. On a weighted basis, this bucket trades at around 23.5x earnings. These are not cheap by the old rules, but they're backed by solid fundamentals. The weighted 3-year earnings per share CAGR is roughly 24.7%, and the median ROE is around 17.3%. Now let's look at the mid caps, roughly ranks 101 to 250. Here the valuation premium is obvious. The weighted PE jumps to around 30.8x. But their weighted EPS growth is 27.6%. The growth is good, but the valuation multiple has clearly stepped up against large caps. And the small cap, which is ranks 251 to 750, sits somewhere in between on valuation but look much better on the price to growth trade-off. As a group, they trade at a weighted PE of around 29.3x. The interesting part is growth. The weighted 3-year earnings per share CAGR is about 33.3%. This is the fastest growth of the three buckets on a slightly lower aggregate multiple than mid caps themselves. Now, if you translate all of this into simple PEG lens, the usual story of mid caps and small caps are where the real value is, that starts to break down. Large caps are about 0.95, small caps are about 0.88, and mid caps are about 1.11. So mid caps clearly carry the highest price per unit of growth compared to both large caps and small caps. You can look at the same story through medians instead of rupee weighted aggregates. You are here using median price to earnings divided by median 3-year EPS growth. On this basis, large caps work out to a PEG of about 1.63. Mid caps jump to a PEG of roughly 2.69, and small caps, they land near a PEG of about 1.73. The median to median PEGs tell the same story, but with an even wider gap. Mid caps again come out as the most expensive segment on a growth adjusted basis, and this time the premium is bigger. This shows you that it is not just a handful of heavyweights skewing the cap weighted view across the typical mid cap stock. Investors are consistently paying up more for each unit of earnings growth. Mid caps, clearly the frothiest part of the market right now. So it's a segment to watch closely for any valuation gap to narrow, whether through a derating in mid caps or there's a quiet catch up from the large caps. Now let's step away from size and just look at the Nifty 750 by PE buckets. Now at the very bottom, truly dirt cheap stocks with PE below 10x, there are only 33 such companies, about 4.4% of the universe and roughly 5.3% of the total market cap right now. On paper, they look amazing. The median 3-year earnings per share CAGR is 38%, median ROE is 15.8%, and the median PB is about 1x. High growth, decent returns, and a low PE, they look like a dream combo. But the catch is cyclicality. This bucket is packed with PSUs and cyclicals like metals, oil and gas, public sector banks, where a one-off rebound from a low base drives that 38% 3-year EPS CAGR. In other words, low PE equals cheap? That's a myth. The market keeps these stocks on single-digit multiples because it doesn't believe this growth is durable. But PSUs aren't a graveyard or a guaranteed growth rocket on the other hand. They are a policy and cycle-driven business where price without durability is a value trap, and durability without price discipline, that's dead money. So in the Nifty 750, moving from 20 to 30x to 30 to 40x PE gives no step up in the medium fundamentals. Both sit around 21% 3-year EPS growth and 15 to 16% ROE. You paid extra for comfort, not for extra growth. Above 40x, that math worsens. Now the 40 to 60x bucket actually slows to a 18.6% median EPS growth. So the greater than 60x cohort shows just 19.9% growth with 11.3% ROE. It's luxury prices for mid-tier reality. And here's the kicker. The true high growth cohort of greater than 25% EPS CAGR, that sits at 35x, near the market median. So paying 60 to 80x is usually paying for the feeling of growth, not more growth in itself. So most high PE names aren't high growth. In PE greater than 40, a majority 55% by count delivered less than 20% EPS growth. So price is outrunning progress. And that's exactly why the idea that growth at any price, it doesn't hold up. In those higher PE buckets, you're not dramatically getting faster earnings. You're just paying a bigger sticker price. But there's an even more tempting version of this: quality at any price. Now, if you go all the way to that extreme, more than 60x PE bucket, it's also packed with companies we feel safest owning. These are strong brands, moats, clean balance sheets, something we spoke about a moment back. We anchor on that comfort and forget the math of multiples, but when growth cools or, sentiment normalizes, even these great businesses, they can give weak returns simply because we started out at a very stretched price. In the Nifty 750, about 9% of the market cap sits in PE greater than 50x with less than 10% EPS growth. It's a crowd paying luxury brand prices for mid-tier growth. And many quality defensives like HUL or Asian Paints, they trade above 50x while growing under 10%. Meanwhile, the 20 to 30x bucket gives you about 20% growth and mid-teens ROE, the same or better fundamentals at saner prices. Now, overpaying loads your outcome with PE risk. Now, if the story hiccups, even slightly, or PE compresses first and your return vanishes. In the 2000 dot-com peak, Infi traded at 382x FY 2000 earnings. In the years that followed, the PE collapsed back towards a more normal 20 to 30x band, even as revenue and profits kept compounding. The business did great. The starting price was the problem. As Howard Mark puts it, and I quote, "No asset is so good that it can't become a bad investment even if bought at too high a price," end quote. And once you see that even quality at any price can hurt you, the next place people run to is dividends. At least I'm getting a payout. But a high dividend isn't automatically safe. Across the Nifty 750, the median dividend yield is only 0.41%. And even at the 90th percentile, it's just 1.96%. That's partly because prices are rich and partly because companies prefer to reinvest rather than pay out, indicated by low median yield, despite a decent median 14.4% ROE. Only 6 companies together, just 1.5% of the total market cap, offer yields above 5%. These high yielders are often PSUs like Coal India. They have a median EPS growth of only 1.1% and a sales growth of 1.8%. In other words, they're basically X-growth equity bonds. Low PEs and high yields are not because they're hidden gems, but because the market sees them as mature, slow-growing cash cows. This directly debunks the myth that high dividend yield means safety. Now, if sentiment turns or stocks derate by even a few turns of PE, years of dividend can be wiped out in a short time. Put all this together and you get a simple lens for today's Nifty total market. In the Nifty 750, valuation only makes sense next to growth, quality, and risk. A PE is just a number until you start asking what growth, what quality, and what risk am I really paying for? And now it's your turn. Which of these traps do you think you have fallen to before? Tell us in the comments below, and thank you for watching this edition of Bottom Line by Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.